If you follow the stock market, you've probably heard numerous times that at the moment stocks are expensive. I know that I've been saying it quite a bit, but what does that actually mean? Hello guys, Brad here from The Guided Investor. Welcome back to the channel for another video. If you're new here, consider hitting that subscribe button because I post regular videos about how you can do more with your money. And today we're talking about what it means when someone says the stock market is expensive. Firstly, it refers to the stock market in general. So not every single stock listed on an exchange is going to be expensive at any given time. Generally, you can find little pockets of value here and there. But when people say that the stock market is expensive, they're generally referring to the market as a whole or the index. So for the Australian stock market, you can think the All Ordinaries Index. The All Ords captures the top 500 stocks listed on the ASX. And simply looking at a chart can give you an indication that the market is expensive. If you set the chart parameters to show you a 10+ year view of the All Ords, you will see that we are near the summit. But the chart doesn't actually represent whether the market is expensive or not. Sure, it's going to show you that stock prices are high, but just because something is high doesn't mean that there's not value in it. In order for something to be classified as expensive, it means that by buying into it at these prices, it represents less value than it traditionally does. And in order to determine that, we have to look at something called the PE ratio or the price to earnings ratio. The PE ratio of a market is calculated by taking the total price of all stocks in that market or index and dividing it by the total earnings. By doing this, you're getting an idea of how much you're paying for the earnings produced, or put another way, how long it would take for the earnings to match the current share price. The PE ratio for the ASX is currently trading at around 35 and the long-term average is around 15, normally fluctuating somewhere between 10 and 20. Now this tells us that people are currently paying a lot more for a company's earnings than they traditionally have, concluding that stocks are currently expensive. Now there are many other indicators out there which help to determine the value in a market, like for instance the famous Buffett indicator, which compares the GDP of an economy to the stock market capitalization. But the PE ratio is generally considered the mainstream way of telling value, and so for the purpose of this video, we're going to focus on the PE. But is a high PE ratio a reason not to buy any stocks at the moment? Well, no. A high PE is definitely a reason to be cautious, but you have to understand why the PE ratio is high. And at the moment, that boils down to interest rates. In an environment where interest rates are ridiculously low, you can't earn any return on traditional defensive assets, so things like cash and bonds. So that forces people to try and get a return elsewhere, into more growth style assets like the stock market. Because even though that the PE is very high at the moment, the stock market is still producing a real return after inflation. However, the biggest risk at the moment is that these settings could change. If interest rates were to rise, and rise enough, then there will be a tipping point at which investors start selling out of the growth assets like stocks and moving back into more defensive assets, because they can start generating a return on those defensive assets without taking as much risk. At that point, stocks would fall and the PE would fall with it. So knowing all of this, what are we doing in portfolios at the moment? Well, we still retain some exposure to stocks and that is not going to change. But we have sold out of some stocks, particularly the large cap stocks, and diversified a little bit into other areas. This includes an increased exposure to the small and mid cap type space, because those companies have a lot more potential to grow their future earnings, so a higher PE is justified for those types of stocks. We've also increased our exposure to alternatives by increasing our real return funds and our market neutral funds. And we have also increased our exposure to infrastructure. So while it is prudent to be cautious of stocks in this market, there's also a very real risk of sitting on the sidelines. Like John Maynard Keynes said, the markets can remain irrational longer than you can remain solvent. But that's it for me today, guys. Thanks a lot for watching. This will be my last video before Christmas, so I wish you guys all the best for the holiday season. I hope you get to spend some time with your family, eat some good food, maybe open some presents, and in general, just enjoy life. I will see you guys in the next one.